easy to get wrapped up in the drama of the moment and forget where you've been. 5 days, down more than 10% on the S&P 500. It's a monster move. We're bouncing back a bit, up by 1% on S&P 500 futures, on the Nasdaq 100, up by 1.28, on the Russell, up by a little more than 1%. There's your opening val. Will it stick? Switch on the board and get to the bond market. Speaking of moves, your 2-year yield this time last year was in at around 20 basis points, right the way through 3% over the last week, up 70 basis points over the last 5 days coming into today's session. The 10-year absolutely flying recently too. It comes in 10 basis points, taking the smallest of bites out of the move we've seen so far. And in the FX channel, I have to say, out of everything happening right now, this is fascinating. Euro dollar 104, cable sterling against the US dollar in at around 120. And seemingly nobody wants a weaker currency this time around. Not everyone can have a stronger one, and right now it's all about dollar strength over the last year so far. That's the cross-asset price action. Let's get you some single names, some movers. Here's Abby.
Well, we certainly do have a nice relief rally here on the open, John, with yields in sharply ahead of the Fed. It seems to be fueling some risk appetite on the part of investors. Tech in particular is higher. Apple up about 1%, of course, the heavyweight to all of the indexes, and the S&P 500 right now on pace for its best day in almost 2 weeks, so very impressive. You also have banks higher, up 1.2%. Interestingly, yields are down, but the yield curve is steepening, so that's helping out banks. Now, of course, we had that weak discretionary number, retail sales number, for the month of May, coming in down 0.3% versus a survey of up 0.1%. And last month, or April, I should say, up 0.9%. So inflation clearly finally hitting consumers. One of the worst areas, as you know, auto dealers. However, the automaker Ford up a little bit. Earlier, it had been up more than 1%, so some wobbly action there. And of course, one of the strong areas, sporting goods. You see Nike, which would supply to some of those sporting good stores, up 1.7%. Overall, a very strong start here for stocks, John.
Abby, thank you for now. 1 minute and 40 seconds into this, we are positive by 0.9% on the S&P. Information technology near the top of the pile, up by a little more than 1% on the West Coast. Ed Ludlow joins us now for more. Morning, Ed.
Yeah, good morning, John. Nice to see you. Happy Fed day. We're up 1.2% on the Nasdaq 100, around 1% on the Philadelphia Semiconductor Index. 2-day rally as it stands in that technology sector as yields, as you pointed out, kind of taking a time out in the moment. But you look at that move on the 10-year yield, and that's the story and the pain that we felt in the technology sector. We started the year talking about a conversation where higher rates discount the present value of future profits for tech. You read across the Bloomberg, and we await that move from the Federal Reserve later this afternoon. The conversation shifting to soft landing and recession risk. You look at the bull run in technology stocks and then what's happened since year to date and the market cap shed on those big names. The concern is really now around principally recession fears and what it's going to take. I like history, John. You look back to the 90s when I was a young man, Cisco took a really long time to bounce back from its bull run high in that period to where it is today. You know, it's not going to happen overnight, whichever direction we go. I like this G chart on the Bloomberg terminal as well, because very quickly it shows the weight that this sector's had on the market. The white line is a basket of, well, basically, if you strip out tech, S&P 500 mega caps fare well. You put tech back in and they underperform, John. So I think we're really waiting to see if the move by the Fed could give us some relief on yields, because we'll have some certainty in the direction of travel, and perhaps that will give us some painless weeks in the sector.
Just quickly, of the companies you cover at the moment, are you hearing anything about job cuts? Because we're seeing it here, there and everywhere at the moment.
Here, there and everywhere. I think what's really interesting is that CEOs offer 2 points of view. They are making changes. They are being at least conservative with hiring, freezing, making cuts in non-crucial roles. But at the same time, they keep telling us that demand is robust. We had Cisco CEO Chuck Robbins on the show with Emily Chang last night. Same message. The demand is there from SMEs right through to large customers. So 2 very competing messages.
I'm convinced there is no one more awake than Ed Ludlow in San Francisco right now.
Kind.
Ed, thank you. It's good to catch up, buddy. As always. About 4 minutes into this, one sector's negative. It's energy. It's down by about 0.4%. Taylor Riggs has more. Hey, Taylor.
John, and certainly a run-up up until today. If you want to take a longer view year to date, it certainly has been oil that's gone up to in the last 2 days about $122 a barrel. But of course, coming off of that with some of the macro headwinds about a Federal Reserve tackling inflation. And so you see that here, looking at one of the largest 2-day slides that we've had in about 3 weeks, and perhaps maybe some demand falling off as well if we're starting starting to get a little bit more worried about the economics and some of the reopening of the economy. There's also some more sort of fundamental news within this industry as well. Of course, in the last few weeks, we've heard a lot of comments from this administration saying that Exxon and some of these oil companies make more money than God, and they need to pay more taxes, and they need to start opening up and helping the American consumer. And so you're sort of getting some of those headline numbers as well, pressuring the industry maybe just a little bit on an intermediate basis. I think that what is interesting, and we have a chart here showing sort of all the profits. I want to be clear that in 2010 to 2014, on our FA function, for example, Exxon, the company actually made a lot more money on an annual basis. Prices were about the same. So certainly making more money, but I think coming out of 2020 when they were losing money and then going back historically maybe 10 or so years ago, numbers also look different.
Are you just a little bit confused by the approach of this administration when it comes to energy companies?
Hugely. I don't understand how you tell them that they're horrible people and then don't expect them to drill.
It just doesn't quite stack up at all. We'll catch up with Anne-Marie a little bit later. Taylor, I'll save you from the politics. Thank you. Just on energy, Bank of America had a fund manager survey out yesterday. I'm sure many of you saw it. All-time low in global growth optimism. Profit outlook the worst since 2008. Then one of the most crowded trades, in fact, the most crowded trade of investors was long energy. Long oil, long energy equities. Now, something surely has to give there. If you believe there's a recession coming down the road, where are energy equities in that world? I would love to know. Brian Nick's going to weigh in on that in just a moment. But there's a ton of pessimism, we know that, and Bernstein's pushing back. Here's a quote from them. The probability of an outright recession has likely increased. It seems reasonable to expect that earnings need to be cut. However, it's possible the market has overshot this. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, speaking of something's going to have to give, there is a mismatch here between the performance of the equity market and earnings forecast. Because usually when you see equity markets rolling over, dropping to the extent they have with the S&P 500 down more than 20%, you would expect that profit forecasts have also rolled over. And yet that hasn't really happened to the same dramatic extent. Yes, the Citi Earnings Revision Index for the U.S. is in negative territory, but the pace of the decline has slowed in the last 4 weeks, while the pace of the decline in the equity market has sped up. And Bernstein points out that's only actually happened twice in the past 3 decades. So either analysts are too optimistic or investors are too pessimistic about the risk to earnings. And that's really the question here. One thing we know for sure is that post-COVID earnings boom, it is now over. After 11.3% growth in the first quarter, companies are only expected to see profits up 5.5% in the current period. And then the second half looks a little bit better, back up to around an 11 handle. But so much hinges on inflation pressure and the margin story. The ability of companies to exercise pricing power, pass on the higher input costs they are facing on freight, on labor, on raw materials to the end consumer, and be able to retain margin. That's something we've seen get a lot more difficult for companies like Target and Walmart. And as a whole, S&P 500 margins already fell to 13.1% last quarter. That's down from the 13.9% peak during COVID. And according to Bloomberg Intelligence, analysts forecast that 54% of S&P 500 members will have lower operating margins in the second quarter than they did a year ago, John.
Kelly, thank you. Thank you very much. Just on Kelly's point, it's kind of odd, isn't it? You hear a lot of people talking about recession risk, but hardly anyone cutting their outlook for earnings. Where is that information? Where's that guidance? In fact, we heard from Microsoft in the last couple of weeks, almost pre-warning, pre-announcing on earnings based on what's happening with foreign exchange. Dollar index yesterday was 105. Where's the rest of them? Where are the rest of them warning about the same thing? Deutsche Bank's Binky Charter put out a note yesterday afternoon. In fact, we caught up with him a little bit earlier too. He said the focus is increasingly on whether forward estimates are too high and will be the next shoe to drop. They remain vulnerable to significant downgrades, even if we don't fall into a recession imminently, and of course much more so if we do. Brian Nick and Nuveen joins us right now. Brian, I'll start with that one. Where are the earnings downgrades based on the recession risk that everyone's obsessed with over the last few months?
I think they only come if and when we start to see actual real data from consumers that shows them pulling back, not just on goods, which is what we saw in the retail sales data this morning, but across a variety of other sectors as well. One other example I'll give you in the small business data, the sentiment data, an enormous number of businesses have had to raise prices over the last 6 to 12 months, but the number of businesses that say that weak sales are their biggest problem is still vanishingly small. So despite the fact that we've seen these price increases, we haven't seen consumers pull back to nearly the extent. I think it's only when we see that we'll get those downgrades in, at least for retail and a number of other sectors as well. We'll start to get some of those recession risks priced into not just the market, but in the analysts' expectations.
Brian, with that in mind, how do you think the market will respond to that?
Well, we've already seen, 22%-ish decline in the S&P 500. I think some of that is expectations that we're going to see some negative earnings revisions. There's certainly some chance of recession. It's not just a bubble that popped and now we're back to normal. But I do think there's the potential for the market to go lower if it looks like that recession scenario, or I think more specifically the severe recession scenario, is becoming a lot more likely. Again, we're not seeing that in the bond market, right? The yield curve is flat, but it hasn't gone into that steep inversion. The 10-year has held up relatively well. So for now, I think, and you see it in the credit markets as well, there's difficulty priced in, but there isn't a recession priced in, which means things can get better, but they can also get worse if the data gets worse.
Brian, if the Fed has to back away because the data's bad, is that a good thing for this market? How does equities respond to that situation? I think that's the number one issue for me right now. We understand the Fed wants to get back to neutral, in their words, expeditiously. That could be 75 today. It could be 75 as well at the next meeting. Then they get to what they think is neutral. I have no idea if that's actually neutral, if they're right, if they're wrong. Let's assume they are. Then a lot of people believe that by the time they get to September, they'll be confronted with some weak economic data. And Brian, I'm not convinced one way or the other how they respond to it. Are you?
No, I'm not. And I think the last couple of days have really given me a lot more doubts about exactly what the Fed intends to do. So ostensibly, we had an upside inflation surprise. I think a week ago, nobody on the FOMC thought they were going to be raising 75 bips today, and now it looks like it's all but a done deal based on an upside surprise to headline inflation, which should not be the Fed's main concern. So if you get weakness in the employment data over the summer, the housing market data, which I think we will see more weakness, more softening in that data, but energy prices stay high, does that mean the Fed's just going to keep hiking? And I think one thing that I think the Fed is probably going to accomplish today by hiking 75 bips is probably a little bit more inflation fighting credibility, but a little less credibility on exactly what its guidance means for the future and how much stock we can take in what it says it's planning on doing. So ideally, yes, you'd like to see the Fed get expeditiously back to neutral. I think we'll see that neutral rate creep up today. From it's probably too low, somewhere around that 2.5%. But assuming we get there and maybe a few hikes past there, my hope and expectation is that by the fall, it's going to be obvious that the Fed doesn't need to do a whole lot more to get those leading indicators for inflation under better control.
Brian, we're going to keep talking about this. We need to talk about energy as well. The S&P right now up by a little more than 1% on the S&P 500. Energy on the S&P down by about 0.6%. Brian Nichols will be sticking with us. Coming up, Washington ramping up efforts to tame soaring gas prices.
I'm doing everything in my power to blunt Putin's gas price hike. Just since he invaded Ukraine, it's gone up $1.74 a gallon because of nothing else but that.
We'll have a conversation about that next.
I'm doing everything in my power to blunt Putin's gas price hike. Just since he invaded Ukraine, it's gone up $1.74 a gallon. Because of nothing else but that. Well, I have a plan to bring down the cost of gas and food. For the largest release of oil from the Global Fund in history.
Pretty frustrated President Biden there. So frustrated he's written a letter to oil companies. Part of it reads as following. At a time of war, refinery profit margins well above normal being passed directly into American families are not acceptable. AMH, I just want you to run through this letter and let's talk about the contradictions of this administration when it comes to this particular topic.
Right. So I think the contradiction you could see at the end of the letter where the president says the administration is prepared to take any, quote, responsible and appropriate steps that would help these countries increase output. So they are going to Houston. They are asking these major American oil companies to help with the refining capacity, right? He talked about the SPR. There's a lot of oil in the market, but there's another issue at play, which is the fact that you have to turn that oil into gasoline, into jet fuel, into diesel, things everyday Americans need and are using right now. So the fact of the matter is that the administration is really trying to get these companies on board, but they feel that this administration, coming in to the beginning of this administration, that the tone has been quite hostile towards them. This administration has really embraced renewables, embraced ESG, and wants to move the country off of fossil fuels. But now they're in a situation where they need them because gasoline is at $5 a barrel, and there's really a gallon, and there's really nothing that's going to be able to fix that overnight.
AMH, I just think we have to sit on that just for a minute about how ridiculous that ultimately is. How can you push ESG for years and then tell the oil companies that they need to build refiners at the same time openly discuss taxing them and their profits down the road? Can you just explain that for everyone? That doesn't make sense.
Well, you bring up another point, which is the potential that there could be legislation, which they would need all Democrats to sign on board of this in the Senate, to tax excessive profits of these gasoline companies and oil companies. And you heard the president say that last week. Exxon makes more money than God, and he's going to prove how much their profits are. We're going to go out after them.
What does that even mean? Apple makes more money than God. Are we going after Apple now? They're basically a cash machine. These kind of snarky remarks at the end of speeches about pay your taxes and all this stuff, who's that for? Is that just for the base ahead of the midterms, or is this about setting policy? So it's about politics and not policy.
Well, it has to be about politics, right? Even when you look at potentially taxing these, quote, excessive profits that the Democrats are talking about from oil companies because they are dealing with this inflation, and they are dealing with a reminder every single day to American consumers that a gallon of gasoline is at a record, and it's the highest it's ever been, north of $5 a gallon. This legislation, Jonathan, wouldn't even come into fruition, wouldn't even happen until potentially the fall. So you already see that this is just about messaging ahead of the midterm elections, because the supply and demand story is not going to change overnight. Even if President Biden takes this trip to Saudi, which we know he is, that will not change it overnight.
Yeah.
And especially when you see the report today coming out of the IEA, they are going to be higher prices for longer, because they say this is a problem that is going to last well through 2023.
AMH, thank you. Anne-Marie, down in D.C., a difficult moment for this administration. Brian Nixdale with us. Brian, for the energy players, something stands out to me that I can't quite see evolving in the same way as some people. Can you have a scenario where global growth rolls over, something everyone is very pessimistic about, looking forward to happening, and not optimistically so, at the same time as energy equities continuing to rip? Do those things stack up? Can you reconcile those two views?
Only if the slowdown is very mild. Interestingly, what we saw in the retail sales data this morning is that people bought about 4% more gasoline in May than they did in April, and gasoline prices were about 4% higher in May than they were in April. So it's sort of a perfect, correlation between the rising prices and how much people were buying. If there is that inelasticity with respect to how much people are spending, then yes, in a softer environment in which purchases of other types of things are going down, gas and energy generally can hold up relatively well. But I think in a more severe scenario, which I think is more what people are forecasting, if we have a hard landing, it's hard to imagine there isn't going to be enough demand destruction among energy users that you're not going to see global demand go significantly lower. Every time we had a China lockdown news, we saw the oil price dip a bit, even though we weren't getting, I think, a full picture of what was happening over there. If you see U.S., Eurozone, UK, Japan going into some kind of recession, then I don't think we're going to be at $120 barrels of oil, and energy won't be the leading sector.
So, Brian, I went through the most crowded trades right now in the Bank of America Fund Manager survey. One was oil, the other was energy equities. And you're comparing two different asset classes, Brian, when you do that. You're comparing a physical good, supply demand clears at spots, to an anticipatory asset class, equities. This is something Goldman has done a lot of work on. And, Brian, at some point, you'd fade the move in energy then. Is that moment right now, given we're already off our highs year to date anyway?
I don't think we want to be underweight energy, but if you have profits in energy, which is probably the only place you do have profits this year, taking some of those and redistributing it into maybe a more defensive mix of stocks, maybe taking a flyer on some of these growth stocks, not the ones that don't have earnings, but the established companies that have gotten really beaten up this year. If we do end up with that softer landing or just a normalized economy that looks more like pre-pandemic, then we know those stocks are going to continue to deliver earnings and deliver returns for shareholders. So distributing it more, I say, not being underweight energy because I think there's still too much risk around the price in the near term, but being more distributed in terms of where the returns are going to come from.
Brian, final word, final question. Just ahead of the Fed a little bit later, this narrative about the Fed going big and that restoring confidence. If the Fed went big today, 75 plus, let's call it 100, would that scare you off? Is that a market you run away from or a market you buy?
No, if they went 100 today, I think you'd see a little bit of a panic in the near term, but I think things would settle down pretty quickly, and there would at least be a sense that we're not going to have a runaway inflation. So that scenario where we have an overheating economy and interest rates to the moon probably gets taken off the table, and that's enough to see a little bit of a relief rally in stocks. It's more of what we saw, just the last 2 months until the last few weeks, with the inflation concerns coming back in. So it doesn't take the recession risk off the table, but I think it does take the rates to the moon risk off the table.
Brian,
so
Nick,
I would be a buyer.
Nuveen would be a buyer. Brian, thank you, buddy. As always, looking forward to the Fed special coverage coming up a little bit later, of course, 2 p.m. Eastern time, the decision. 30 minutes after that, we'll hear from Chairman Powell. Coming up, your trading diary from New York City. This is Bloomberg. 25 minutes into the session, equities higher by 1.3% on the S&P, on the Nasdaq up by 1.5%. Going into the Federal Reserve a little bit later this afternoon, a lot of the refreshed calls we've seen going into this one, looking for a 75 basis point interest rate hike. As the price action, here's your trading diary. The focus on central banks. The ECB President Christine Lagarde scheduled to speak at 12:20 Eastern this afternoon. Look out for that. And then it's the Fed's turn, a rate decision at 2 p.m. Eastern time, followed by Chairman Powell and the news conference at 2:30 Eastern. The Bank of England out with a rate decision tomorrow morning. Looking forward to that alongside jobless claims too. And finally, we round out the week with a Bank of Japan rate decision on Friday as well. Is that enough for everyone? More still to come from New York City. This was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, June 15th. Here are the top market stories that we're following for you at this hour. Hurry up and wait. The ECB's emergency meeting underwhelms by going long on words, short on action. The bank now says it will accelerate a new tool to fight against fragmentation. And the Fed plays catch up. Markets and economists increasingly expect a 75 basis point hike today as central banks fight to retain credibility. And Bitcoin teeters on the edge. Price bounces off of the 20,000 mark as crypto investors struggle to stay afloat. We're going to speak to Michael Schonenstein, Grayscale Investments CFO. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Whatever you think the ECB should have said, they did move bond yields significantly to the downside over in Europe, and now I feel like we have to wait and see if it can sustain that come to when we get the Fed announcement.
Yeah, in some ways, we anticipated a lot out of the ECB. We didn't get it, but as you say, the market reaction has priced in something, and we've certainly seen spreads compressing, bunds to BTPs. As you say, though, I think we'll probably now move on to the main event, which is the Federal Reserve a little bit later on. Alex, it feels like 75 basis points is now priced. What do the dots say about this story going forward? I think that's going to be absolutely fascinating. But what we have certainly seen over the last few days is a significant repricing in the mortgage market. Mortgage rates have been going higher. We're getting some data out right now. The National Association of Home Builders index comes through exactly as anticipated at 67. Remember, this is a gauge that goes 0 to 100. Anything north of 50 is positive. But we are seeing a slowing, Alex.
Yeah.
69 was the last number. 67 is this number. This could be one of those moments where Alex gets to talk about where on that chart she took out her mortgage.
Yep, it would be right at that low that you saw in the beginning of 2021, right there. It just shows how fast it really has re-rated. But I think what it is interesting is this is what the Fed does want to see, right? I mean, they want to see the housing market cool off the same way that they want to see U.S. retail sales slow a little bit. Are we starting to see the first signs of that demand destruction that we need to see to get inflation under control? I guess it just raises the question of how fast that can re-rate to the downside.
So let's talk about our question of the day, because we pondered this. We ruminated on exactly which question we should be asking today. And the problem was we couldn't come up with a convincing answer. So then we thought about this. Which mistakes or which mistake are central banks making right now? And there's a number of different ways of looking at this. Are they behind the curve? Should they be doing more? Should they be raising rates faster? Are they risking a recession? If they raise rates now, is there going to be a recession in the near future that they're going to have to reverse? There's all kinds of things going on here. But I think the problem, Alex, is very different on each side of the Atlantic. The ECB feels like it's got one problem. The Bank of England feels like it's got another problem. Then the Fed has got a completely different problem. So maybe they're all making different mistakes. Well, let's ask that question to Michael McKee, Bloomberg's international economics and policy correspondent. We're also joined in New York by Christine Aquino in New York. Mike, I'm going to ask you, though, the first response on that one. Get the first response on that one. Which mistake do you think central banks are making right now?
Well, I have to agree with you, Guy. The situation is different on both sides of the Atlantic. It is very hard to say what a mistake is, except in hindsight. What may be happening here is the U.S. economy is already slowing. You and Alex were talking about home sales starting to slow. Auto sales have slowed, and retail sales came in negative in the past month, even though inflation was up. So is the Fed tightening into a slowing economy and speeding up that pace of tightening, given the fact that we see a long and variable lag, as they say, with the impact of interest rates? Could we be seeing those impacts start to hit at a time when the economy has already really slowed? On the European side, the question is, are they going too fast for the kind of monetary union they have constructed, where everybody has a different economy? This gets to the question of, did they make a mistake last week by not talking about fragmentation, and did they come back and do something acceptable about it today? Doesn't look like the markets are buying it, but there are a lot of people who say, you know, we've seen spreads go up, but they're not up anything like they were back in 2011. So it's hard to say they have made a mistake yet, but there are possibilities out there.
Sure, and the market definitely re-rated, but we do have to wonder, like, why call an emergency meeting and not actually announce anything, I think is puzzling many people. Christine, I guess take the ECB side. I know you're here in New York, but you cover macro over in London. From the ECB side, like, what's that mistake? What's the biggest mistake the central banks are making?
Well, Alex, I think from the ECB's perspective especially, but really this applies to all central banks, is really underestimating markets' ability to overreact to what central banks are doing. I think the reaction in markets that we're seeing right now to the ECB is very much part and parcel of the initial reaction they had when Christine Lagarde was asked the question of fragmentation at the ECB press conference last week. And clearly markets were not satisfied by that answer. They reacted accordingly. And now we see the ECB almost trying to catch up a little bit bit with that reaction in the markets and finally acknowledging that, yes, they do have to do something very specific addressing this fragmentation risk that perhaps they may have underestimated at the time of the ECB press conference.
Christine, do you think markets are reading too much into central banks? Do you think central banks are reading too much into markets, to kind of pick up on your point? I found it fascinating that we got the Wall Street Journal article earlier on this week, which basically took us towards the repricing for 75. The ECB seems desperate to communicate with the market that it's got this one. Is there a danger here that the mistake the central banks are making is to try and fine-tune things too much, trying to micromanage things too much, trying to over-communicate too much? Is that the mistake they're making? Because at the moment it's so difficult. The data is all over the place. The macro environment is incredibly difficult. Trying to fine-tune this story, very difficult, and the potential therefore for mistakes, huge.
Absolutely, Guy. I mean, I think, you know, policy making is a very kind of a different tool, right? But when it comes to markets, it's kind of this blunt force that really reacts massively and really kind of, it's unstoppable in one direction if it really wants to go there. I mean, this is exactly what we saw, for instance, in Fed pricing, in the Fed repricing, I should say, over the last couple of days. I mean, even before that Wall Street Journal article that you're referencing, we already saw 75 basis points pricing for July for the Fed after that blowout CPI figure on Friday. And that, of course, really just accelerated after we saw that article. But, you know, again, it's markets kind of overreacting, as you say, but there's really only one way that they usually go. It's kind of overshoot that reaction once they get some kind of catalyst. Think about the consequences or perhaps fine-tuning that reaction a little bit later. And I think this is where central banks need to understand it's a market's tendency to kind of hit the sell or buy button first, depending on what they're selling or buying, and then think about it later.
So, Mike, I think that also then raises the question going into the Fed meeting in terms of the summary of economic projections and the dot plot, because as traders are kind of bringing forward their rate hikes to bigger and faster rate hikes, then you have economists worrying about a recession in 2024, and I wonder then how we read the dot plot, considering that they had to deliver their projections and stuff right before that inflation number.
Well, there's no reason they couldn't have adjusted their forecasts after the inflation number. I mean, I think if it significantly moved the dial on one of their models, they would come into the meeting and say, look, we can't put out an old number like that. The problem with the dot plot and the SEP is that they quickly become outdated. And we've seen that happen since the March meeting, the last time they did it. Markets react minute to minute to developments, and the Fed puts out a new forecast once every 3 months. So it's kind of hard for them to keep up, and then the markets react to the fact that the Fed forecast is old. So it's a kind of a no-win situation. What we will get today is markets will look at what the Fed's saying and see how it compares with what they think is going to happen. And for a couple of days, we'll be fine. But then we'll get some more data next week, and people will look around and say, you know, is the Fed behind the curve, or maybe are they ahead of the curve? One interesting thing that I have heard over the last couple of days is that perhaps the Fed is looking at this as, if we are tightening into a slowing economy, and there's some preliminary signs of that, then maybe we front load and we move up the number of moves we're going to make and make them earlier, so that by the time they hit, we're not still raising rates by 50 or 75 basis points because we're looking at backward-looking data. So that's also a possibility.
One that I'm sure President Biden is thrilled about with the midterms coming up in November. Guys, thanks a lot. I really appreciate it. Bloomberg's Michael McKee and Christina Aquino. And tune in to Bloomberg's special coverage, The Fed Decides. That begins at 1:30 p.m. New York time. Now, coming up on this program, more of our question of the day. What mistake are central banks actually making right now? We'll discuss with Nathan Sheets, Citi Research Global Chief Economist, coming up next. This is Bloomberg.
The Fed says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But could it be 75?
We are looking at the possibility of a 75 basis point rate
Some
hike.
big questions about the next move, the one after that, and ultimately the destination.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg Surveillance.